The important thing is to ensure that the loans that we originate today will be repaid accordingly in 7-10 years at maturity. And that is something that can be tricky if property values have gone down simply because the properties have stayed the same, but the cap rates have increased. So how do we manage to have control over that? What we look at is the debt metrics per square meter, for instance, and ensure that comparing with long-term trends, they make sense. But also because the interest rate environment is so specific today, we ensure that we can survive a major increase in interest in 7-10 years when loans have to be repaid. And that is done via some financial covenants, like the debt yield covenant, which has been introduced on some loans lately. And that is a strong protection for the lender, and which is good for the borrower as well, enabling to monitor the situation when getting closer to loan maturity. We see some emerging trends which concern the acquisition of, I would say, non-core properties. So that can be healthcare facilities, that can be co-working spaces. And it's a challenge for us because, of course, we need to understand perfectly how the investment market, how the letting market works for these assets. So it's still a niche, I would say, today. But the question is, well, will that take more importance? Will that become a big part of the investment markets? I'm thinking of the residential, for instance, or will it remain quite marginal? So we are having a look at that, and the arbitrage is: do we invest to develop a new product, or do we remain in our core business where we have a very strong expertise?